Thanks so much for tuning in to our real estate investing program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for the weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. You can also go to TomWilsonProperties.com to sign up for our economics newsletter that comes out weekly. Also, by signing up, you can get access to products that we have available in the investment arena in rental houses, multifamily syndications, and commercial syndications. We always welcome your questions and your suggestions for guests and topics. And there's a lot of education information on our website about syndications, about real estate investing, how to get started, and so forth. And we always pleased to give free consultation if you'd like some assistance in answering your questions and help navigating your real estate investing ship. So today we're pleased to have on the program with us in studio Jean-Marc Landau, who's been a real estate investor for 34 years, as education and as an engineer and economics, and he's been a lender in both residential, multifamily, commercial world for 24 years. And it's also we have a partnership with Jean-Marc for syndications. So we're very pleased to have him on, and thank you, Jean-Marc, for being here, and welcome to the program.
Thanks, Tom. It's great to be here. Thanks for having me.
So Jean-Marc, tell us what was your initial career pursuit, and then what steered that away from that onto real estate? Give us your kind of how you got started story.
That's actually a fun one. I was looking for a house. I was working as an engineer originally, and
well, that's a brand new story here in Silicon Valley. Yeah, nobody's moved from engineering or high tech to real estate. So.
No, just about half our group. But no, I was looking for a house and making decent money at the time. But interest rates in 1982 were 19%. And lo and behold, I couldn't qualify for the loan. And I was looking for a house with an in-law to maybe help me out. That worked better. Three units worked even better. Then I figured out that 5 units and up, they actually looked at the rental income, not my income. So even though I couldn't qualify to buy a single-family house, I could buy a 6-unit. And that's what I did.
Ah, now that's a piece of the story. Even though we've known each other for some time, I didn't realize you had started in multifamily.
Yep. No, my very first piece of real estate was sixplex. I didn't really have the down payment, so this was condemned and in foreclosure. I quit my job, rehabbed it, and 9 months later, rates had dropped to the incredibly low rate of 12.5%. And I refinanced, pulled out 4 years worth of salary, and that was kind of the end of engineering for me.
How long were you in the engineering world, the high-tech community? How long did you work in that? How many years?
Actually very short, 1.5 after college.
Wow, you got smart a lot faster than I did. I said, so good for you. So where was the first property?
In San Francisco on Alamo Square.
My goodness me!
We were
and at those interest rates, and it worked out back then. The numbers worked even then.
Oh, it worked beautifully. I mean,
even though it was San Francisco. Yeah.
I mean, if you can imagine, in San Francisco, sixplex back then was $330,000. And around the corner, as I was rehabbing that, I was doing my own contracting. I hired out to make a little money on the side. There was an owner of a 12plex around the corner. He had bought in '73, so imagine buying 12 units in San Francisco for $27,000.
My goodness me!
He probably makes more than that per month right now.
Yeah, that's my first rental was in 1970. It was $30,200. I remember my wife's hand shaking as she signed that contract. She assumed we'd be eating hot dogs and baked beans the rest of our lives, and that rented for $300. That was my introduction to 1% ratio back then.
So in that first building on Alamo Square, I found an old rent book. Dating from the 19-teens. The rent was 1,700 square foot apartment. It was $4 a month.
Are you serious?
That was fun to find in the closet.
Did you hold on to that?
I did.
I
still have it.
That's quite a souvenir. That's good.
I held on to that, and also the mercury switch for the boiler in the basement, and various other turn of the century paraphernalia.
Very, very interesting. Yeah, that's a piece of data that's kind of hard to get. Bruce Norris and Sean O'Toole went back to Washington D.C. one time to try to dig back on interest rates, because there's nothing much published longer than like 50, 60 years ago, and they went back to the mid to late 1800s and looked at all the interest rates. They pulled up on microfiche every Sunday's paper that advertised the rates, and they dispelled the theory that when rates go up, real estate stops. It's not true. Everybody assumes that's the case, but it's not. So here you have some rent history that's probably pretty hard to find. That'd be fun to see. Only us techies like seeing things like that. That's right. So where did it go from there? Your investment.
Well, I pulled out this cash,
Experience.
and of course I did it again. I bought a 6-unit in the Lower Haight, which is a fairly rough area at the time, much nicer now. And then another 6, and another 6, and another 6, and a 15. And sort of in the middle of all that, we had some really good successes, some medium successes. And then on the 15 units, I moved everyone out, and 11 of the 15 tenants decided to come back after the renovation. And off to the rent board I went to petition for my capital improvement pass-throughs. And they said, well, we don't really understand math, so we'll give you 10% of what the law allows you. And off to court we went, and I battled the rent board in San Francisco. Successfully, but it was a Pyrrhic victory.
How long did that take?
It took 2.5 years.
Wow.
So between the rolling my construction loan and paying legal fees, and the economy going from an upmarket in '87 to a down market in '89, ended up dumping that property for a small loss.
Every time we abandon free markets, the ones that think they're going to benefit the most wind up getting hurt, don't they? Unintended consequences. It's by like rent controls and so.
Yeah, no, we can have a whole show on rent control. I'll hold my tongue at this point.
Let's talk a little bit about property management. We've got a few minutes left on this segment here. So what have you learned about property management that our listeners might like to hear, and what are some of the things that work and haven't worked, and tell us about that.
Well, I mean, one of the big things and sort of the aha moment, I read a book, and after the 2008 crash, I was really scratching my head and reading a lot of things. Okay, what next? And what I realized is kind of what I had been doing wrong for 30 years, which is the 6 to 20 unit buildings is really a job. And to be an investor, you need to scale. And part of that is understanding that you don't have to scale in the Bay Area. A 200 unit in the Bay Area might be 200 million. A 200 unit outside of the Bay Area might be 5 million, which is a pretty stunning difference.
Yes. Remember my first revelation about how different it was. My jaw dropped and recalculated 3 times. This can't be right, but it is.
It really is. So understanding, on a 6-plex, I'm plunging toilets and I'm letting tenants in at 3 in the morning when they've locked themselves out, etc. On the larger units, you have a local property manager that manages an on-site manager, an assistant manager, maintenance supervisor, line maintenance. You basically have an entire team on site that's doing everything. So I don't do toilets, I don't do evictions, I don't do tenant screening. It really is managing the manager and determining the direction of the property and then making sure that all the numbers and the metrics are there, that they are performing as we had predicted, and doing course correction, but really not managing the day-to-day.
I'm always amazed when you run across speakers who say, you ought to buy stock or something other than real estate. If you're tired of toilets, tenants, and termites, go do something else. And they don't seem to understand that. Just like any other company, right? It's trusting and having good quality management is what makes it successful. Not going in there and I don't think any of the CEOs of companies are there sweeping the floors at night or anything else. That all that stuff can be delegated, and in fact, the folks you delegate it to can usually do a better job than you can, right?
Oh, absolutely. Early on, I tried to do my own legal, and 3.5 months into an eviction, I realized in court that I had, mischecked a box in 3-point type. I had an oral agreement of the lease, a copy of which was attached, And because it was an oral copy, not a written agreement, they threw out my eviction, so I started over a 3.5-month process and lost 3.5 months of rent because I was trying to save a few dollars on an attorney. On the larger units, everything is paid for, everything is in the budgets. You're not doing your own, you're hiring professionals to do it, people who do it day in and day out and know what they're doing. You're not trying to be a jack of all trades and do it yourself. And that was really the lesson that I learned there.
Well, if there's any silver lining, I'm sure you learned a little bit more about the legal system so that you can better interview and screen the attorneys you're going to hire and delegate to, right?
Oh, yes. Oh, yes. Quite a few of those under our belt.
How do you choose a property manager? What are the things you look for?
We have a list of 95 questions to ask our property manager, from whether they're managing their own properties in the markets, to how they're running their books, how they do their reporting, really how they view the market. There's so many different aspects of it. And when we go into a new market, we actually look for the best property manager in the area for the particular property class and the worst. The best is going to manage our property. The worst, those are the buildings they're managing are our target buildings. So that's where we
target buildings for what?
For acquisition.
For acquisition. Okay.
Because we know they're mismanaged. So we can do better.
When's it mismanaged? Just in the 40 seconds so we have left on this segment, what do you think their biggest mistakes are for a property manager that doesn't do as good a job?
We've had some where the accounting wasn't even up to snuff. They didn't have a handle on what was coming in and what was expected. We've had some people that just they do an eviction, but they stop halfway through. Mm-hmm. It's really stunning what some of the misfires are. Mm-hmm. You would think that normal logic would prevail, but not always. Mm-hmm. So it's kind of interesting. So they just sometimes I find that what happens is they were good when they were smaller, but as they grow, they know how to manage tenants and so forth to some degree, but when they grow, they don't know how to delegate and they don't know how to run a business, and so they're still trying to do everything like they did before. We have Jean-Marc Landau on with us today in the studio talking about his experiences in real estate investing so that you can take that information and help make your investments better and avoid some pitfalls. So stay with us here on KDOW 1220 AM, and we'll be right back. So nice to have you with us today on the program. We're very pleased to have a special guest in the studio, Jean-Marc Landau, who's a 34-year real estate investor and also had 24 years experience in the lending business, which we'll get to a little bit later. Jean-Marc, before the break, we were talking about property management of multifamily properties and the things you need to be careful about and to the pitfalls to avoid and what kind of property manager to hire and how important it is to delegate this task to someone else and not try to do it yourself. Of course, with large multifam, it's pretty tough to do, although I'm surprised every now and then I run across somebody that tries to manage all that themselves. And that sometimes I think that's a disadvantage of having a property nearby, because you can technically do it even though it doesn't make sense. When you have a property that's away from you, then it kind of encourages you to do what makes what's more practical. So what else can you tell us about property management that you've learned? Well, it's interesting when you jump, going from a single family to a sixplex or something. I mean, you can pretty much figure out what it's going to be. If someone pops you into a little sunfish or a Hobie cat, you can kind of figure out how to sail it. Mm-hmm. You might capsize at some point, but not a big deal. You just right yourself. If someone puts you behind the wheel of an oil tanker, you better know what you're doing.
I like that analogy. Okay. Yeah.
And when if you're turning an oil tanker, you have to think 3 miles ahead, and then it finally turns. Mm-hmm. Same thing on a multifamily. If you're taking over a 200 unit that's mismanaged, it's going to take you a while. On a single family, you change the tenant, you're done. And you might have 60 or 70 vacancies. You find 10 good tenants, but you still have to find the other 60 or 50 and fill them. And maybe you had 10 good ones jump in, but it's just slowly getting all of them lined up.
And the bad part is if you it needs a higher skill set in order to manage that big tanker of a multifam. The good part is if you have the skill set, you can really differentiate yourself from the competition quickly, can't you?
Yes, absolutely, absolutely. But I mean, it's having a good team on the ground, having a good property manager is key. Having good vendors. You know, when you hire a contractor and they start a job and finish it on time as scheduled at budget, it's perfect. When they come in and start a job and walk off halfway through, and you have to hire someone else, and you've lost time, you've lost money, you've lost the credibility of the tenants. All of that matters. So when you're looking at hiring the right manager, I mean, literally, I won't go through the list of 95 questions that we have, but you know, it's really kind of feeling whether they're aligned with you and whether they're capable. And that's really where we go. The other really important thing is you may have, if you think about asset classes, if you have the best asset manager for an A-class building, that is not the person you want for a C-class and vice versa.
Indeed.
If you have an A-class manager managing a C-class building, when the fridge is scratched on a turnover, they'll replace the fridge.
With a real nice stainless steel front one, is it?
Yes, yes. And I want the C-class manager that's going to buy that scratched fridge from the A manager for a discount.
Indeed. John, what would you say are what's been some of your best sources of education? How have you learned how to be successful in this business?
You know, when I was doing the contracting early on, I really learned, I just used engineering analysis and tried to do it. So I did one job where it was a kitchen and bathroom model that I had done many times, and the owner asked us to replace the windows. So I pulled off the casing on the outside and kind of rebuilt the windows and put in these beautiful windows. And 2 years later, I saw an ad for replacement windows. And you pop the beads off, you put the replacement window in, and you pop the beads back on. So the client got a great product, but we could have done it in half the time and less cost, probably 30% less cost by getting the replacement windows. So when I'm looking at you know, investing in real estate, it's really what happens, what have other people done successfully, and how can we emulate that? So it's very easy to think that we can outthink the market and we're smarter, but I'd much rather go after, you know, what someone else has done successfully and emulate that. It's so much more. So much cheaper to learn.
Some people like classes, and some people like books and tapes, and you know, all of that is valuable. But and of course, you know, hands-on experience are the things you learn a lot, but it takes a long time and money. But it's I think watching others, asking those with more experience your questions. That's how I learn the best, and. I think the transferable skill sets from other disciplines or other careers you've been in are very valuable too. We have Jean-Marc Landau, a very experienced investor, and especially in the multifamily arena, in the studio with us today. Stay with us, and we'll be right back on KDOW. Thanks for being with us today, and thank you, Jean-Marc Landau, for being with us. He's sharing with us his experience as a real estate investor, and has had a lot of experience in the multifam arena. I like houses. I have a bunch of houses. We provide about 600 rental homes to others for investing for their long time, you know, future and retirement passive income. I like them for the fact that they simple to operate or manage. They tend to appreciate a little bit more, and they're more liquid. However, if you can be in the arena of larger scale, there are some advantages indeed. And what would you say a multifam's advantage is over houses, Jean-Marc?
Oh, there are lots of answers to that. But first, I mean, I love single fam also. You know, having rehabbed them, I get to be more creative. And when you're looking at certainly high-end stuff, it's more of a design. Satisfaction than
that's where I get in trouble. It's fun, so therefore probably
it gets
not as
expensive.
yes, that's right.
But on the multifamily, it's more production, so you have to find a level of finish that is sort of the and you can play around and dial it in, but you find a level of finish that's sort of the ultimate level at, you know, the price reward.
Right.
Schedule.
But why is it better? What's multifam?
So the multifam, for me, I'm a math guy, so I look at the numbers. And on a single family, if your rents go up $25, big whoop, you go to the restaurant one extra time a month, cheap restaurant, at least in the Bay Area. On a 200 units, if your rents go up $25, take $200, 200 units times $25 times 12 months divided by an 8 cap, and the value of the property is based on the net operating income. So as your net operating income goes up, and that $25 bump raises your NOI.
And for our listeners that aren't familiar with it, net operating income is just essentially the income minus expenses without the debt service.
Correct. And then the cap rate is a measure of the return of a particular property without not counting debt. So literally, cap rate is the net operating income divided by the value. So the value is really the net operating income divided by the cap rate.
Now you can have 200 houses, or since the price of a house is usually higher than an apartment, you could say you have an equivalent dollar worth of houses as a multifam. So since you can have either one, you get that same $25 bump across the way. So why is multifam better if you invest the same amount of money?
So the single families are based on comparable properties. They're not really based on the income. The income from the multifam drives the value. So that $25 bump, really at an 8 cap on 200 units, raises the value by $750,000.
And on a house, if the value of the house goes up, but you're trying to sell as a rental property, it's kind of capped by how much that rent is, regardless of how much the owner-occupant market is for that house, isn't it?
Right. So if you have a bunch of houses in an area, even if you raise the rent by $1,000, your value is still based on the next door comp.
Mm-hmm. Okay.
So here there's really no cap on the multifam. It's what the bigger the cash engine you can create, the better off you are.
So in general, I think a multifam to me is it's got economy of scale. It's more efficient to run. You can have a property manager in place, and I don't like having a multifam that isn't big enough to afford full-time on-site management. That's when you can start to control your quality, your tenants and their behavior and what's going on. You get your maintenance people on site, and then you've got your own people fixing things instead of having to farm them out to independent contractors that tend to cost more and so forth. So so there are a lot of advantages of multifam, and we'll be back to talk a little bit more about that with Jean-Marc Landau here in just a few moments here on KDOW 1220 AM, the Wall Street Business Network. Stay with us, and we'll be right back. Nice to have Jean-Marc Landau with us today, talking about his experience as a real estate investor. Unlike most investors, he kind of launched straight into larger products and discovered the economy of scale that you can get by operating a larger product. It isn't all roses. You got more eggs in one address, so you got to be a little bit careful with that. But it's worked out for you pretty well. What are two or three things that you can attribute your success in real estate investing to? Would you say one of them is by kind of jumping straight into larger products?
It's interesting. A lot of people think they need to go through single-family investing before getting into multis, and it's really just a different animal. Whether you start with a motorcycle or a car, it's the same thing. You learn one and you're comfortable with it. I think jumping into 200 units might be a little much, but jumping into 6 or 10 units is certainly anything that a reasonable, logical human being can do.
It does have the advantage also in this era of being fannied out with 10 loans. It's funny, when I was at Fannie Mae last week giving a presentation, and I mentioned fannied out, most of them had never heard that term before. It brought a good laugh and wanted to know what that was. But you can have 20 commercial multifam products, and not a single one of those loans shows up on your credit report, right?
Yep, no, it's quite wonderful. As a loan broker, I had lots of investor clients, and we're getting very creative trying to get their properties financed. Mm-hmm.
So you think scaling was something that helped you? What's something else that helped your success? Probably picking good property managers?
Picking the property manager, you can't state highly enough the importance of picking a property manager. We've had a couple of false starts with property managers. We had actually one. I won't go into particular experiences, but you start with one, and then someone builds a building across the street that's 7 years newer than yours, and all your tenants migrate across the street. Yeah. Well, there are ways to plan for that and see it coming.
Yeah. One of my one of my associates and friends who's done a lot of investing, has a lot of doors, often quips that he's thinks he's fired more property managers than he's ever hired. So if you can get hooked up with somebody or get a reference or get connected with someone who's already done all of that tough screening, that's a big advantage, I think, is to find out folks that have already been vetted and have worked out well for somebody that you're buying from or investing with, right?
Absolutely.
Yeah.
The other thing is when you're going to an area, and especially as we're buying across the country, there are certain metros that we're getting more and more comfortable with, and the more you learn about a metro, the better off you are. But calling your property manager that lives there, I may not live, I can only live in one place, but your property manager typically lives in the metro where they're managing. We run, before we even get very far down, to make an offer, we'll talk to our property manager. What do you think about this? What do you think about these numbers? This is how I'm seeing the numbers. Are you seeing them differently? And across the street can be completely different, literally. You can have a 900, again, these are not Bay Area numbers, but you can have a $900 a month rent on one side of the street and a $600 a month rent on the other side of the street for good reasons. And you wouldn't know that.
Yep, indeed. And, something that you kind of alluded to a little earlier that I certainly tell people I think helped me, and I'm sure helped you too, is I'd say most of the investors that certainly I know in the San Francisco Bay Area, there are a lot of techies here, but they aren't all techies. But I'd say a disproportionate number of techies have invested in real estate, and I think that's because they're analytical and they buy based upon the numbers and not emotion. And I think that's a significant advantage, and people sometimes just don't fully appreciate their skill sets and how transferable they are from one thing to another. But you got to recognize that you have them and use them. And I know you do. I've seen how you analyze a new deal that you're looking at in excruciating detail and with a lot of due diligence and help, and it's very impressive. And that's what allows you to pick the good ones from the bad ones. Right? Yeah.
No, running the numbers is absolutely key, and I fall in love with the numbers first and then the property. But also just with the advance in technology, the ability to Google Drive a neighborhood and see whether you're a block from a Gucci store or from a XXX video store really makes a difference. Is my clientele going to be able to afford what I'm looking for?
I think those of us who are techies have watched the evolution of this technology. It's even more impressive to us than it is, a layperson for technology. The things that we can do today, and in fact, they're anyway. So yes, be able to do that. Certainly, when we started off, you and I started off in this business, it was a little bit harder. You had to have some feet on the ground, both folks you delegated to and yourself, and not that you substitute that, but at least for first cut, it's wonderful to be able to use that kind of technology, isn't it?
Yes, it's from Google Maps to statistical data to forward-looking projections. The amount of information available at your fingertips is truly phenomenal, and it's completely transformed the industry. It's much more transparent, so you can also hide less. So
good point.
I see fewer quote-unquote deals. If there's a property worth $10 million and we're not going to pick it up for $5 million, the seller is going to know that it's worth maybe 8 or 9 at least, not 5.
Yeah.
So it's on the one hand we don't get the steals, but at the same time we get much more solid data that we can rely on and hit lots of doubles and triples, not necessarily grand slams.
Yeah, I think I've always felt it's a lot better to have more deals with less margin than to get that one bad deal. You can go down a surface street and say, wow, I'm cruising along at 40 miles an hour. What's the point of going on the freeway? But boy, that one stoplight really kills your average real fast. Or that one loser trip you took to Las Vegas. It doesn't. Nobody reports that, but boy, it really kills your averages in a hurry. We have Jean-Marc Landau with us in the studio today, talking about his experiences in real estate investing, and we'll be back for a recap in just a moment. Jean-Marc, thank you for being with us today and sharing your experiences. I don't think there's anything more valuable than for people to hear what others have learned, both what to do and what not to do, and we appreciate you sharing your experiences. You've had a lot of it, and it's very nice. So in these times of $20 trillion worth of debt and uncertainty in the country and the world, are you still positive on real estate investing compared to other places to put your money?
Answer is an unqualified yes. It's funny. I was traveling in Ireland and reading in the bookstore. I just picked up little snippets that the Countess of so and so had 9 lodgings that she rented out to support her estate. This was in the year 1100 something.
Oh, okay. Okay, need a little context for that one. Go ahead.
Rental real estate has been working for thousands of years. It continues to work. Obviously, there are going to be some ups and downs in the market. Market cycles are normal. Understanding how to read the market cycles and seeing the difference in timing between different markets is key to really playing the game correctly. A lot of people get into one market and ride it up and then ride it down. If you can ride it up and get out and go into another market that's down and ride that back up, then you can stay on the up curve a lot more. But long term, I think real estate outperforms almost any other investment that I know of that's easily accessible. Obviously, venture capital and various other things make more. Doing a fix and flip is a job, but you can certainly make more quicker. But just in terms of potentially passive investments, rental real estate to me is really it. It's the cat's meow.
Mm-hmm. And really key to not learn the hard way and get expensive education, but to partner yourself with somebody that's got the education, find managers that really know how to manage it, and stay in touch. I think this day and age we have a lot more tighter coupling between what's going on in the economy and its impact on real estate. So going to things like you and I just did at Bruce the Norris Group's I Survive, where we have some top economists from the country there telling us their perspective on it. I was quite pleased to see that the panel there of 7 who in the past have had expressed some real concern and uncertainty. They certainly don't see any panacea, but they all painted, I thought, a relatively positive picture for a while, and the fact that we are, we're still as Dr. Doug Duncan says, the prettiest horse outside the glue factory. I think real estate's still a good place to put money. Jean-Marc, thank you for being on the program, and again, go to TomWilsonProperties.com. And you can sign up for our weekly newsletter, get connected with us so we have a relationship with you, and you can get access to new products that are available. Many of those are only available to our listeners and to our client base. So that's a very worthwhile thing to do, and there's lots of education information on that website as well. So thanks for being with us on our real estate investing program, and it was great to have Jean-Marc on here today. Again, we welcome you to tune in each week, and remember that the only thing that matters is what you do next.